Welcome everyone to tonight's asset protection webinar. If you are, continue, too much technology. If you're brand new to us and don't really know what we do, this is a long-running asset protection series. We've been teaching webinars for well over a decade, and on our YouTube channel and on our website, we've got most of these recorded. We try very hard to record this. If you come in a little bit late or you need to leave a little bit early, this is being recorded. But the beautiful thing about being on tonight is you get to ask Eric and Steve questions. And so, Steve, Eric, how do you want to play this? Do you want to teach for a little while and then open it up to Q&A at the end? Is that better flow for you?
I think that's totally fine. Or if people have questions, I assume they can type them in the chat bar, and maybe Kendall, you can occasionally, I'll stop for a minute and you can ask some of the questions, and we can answer some of them as we go, because I don't want to put anybody's question off that's really dying to ask something.
If it's pertinent, I'll go ahead and drop in, but other than that, yeah, let's hold most if we can to the end. Yeah.
Okay, so there's going to be two screens. One is a chat screen, and that will be if we want to, share information, link or anything to the students. But most of the time, use the Q&A screen and type in your questions, and then we can play off questions. And if it's urgent right now, we'll do it, and if not, we'll wait till the end. So. We've had some amazing seminars or webinars so far this year with Clint Coons. We had the president of the iPlan group here, Jill Banner. We've had an amazing couple strategy sessions with Mike Koval, stock investor, saying here's what's happening in the market and some very simple ways to beat the market. We've had Scott Estel, the former senior trial attorney from the IRS, on a couple times already this year, and we're planning a couple more with him. Steve Sumption was talking last week about, or 2 weeks ago, mediation and arbitration to avoid lawsuits. And it's been an exciting webinar year for us. We've got Chris Johnson and Gene Garino coming up in the near future. So watch your emails, and you're always invited, especially to attend these live, so that it gives you a chance to answer questions. If you'd like to watch any of those videos, you would find that on YouTube. So it's real easy to find us. You'd go to YouTube, you would type in Protect Wealth Academy, and then simply hit subscribe. And that way, whenever we post a new one, you'll be able to see what we're doing. But that's the easiest way to get the recordings we've recorded in the past. And then we've got a 3-day summit coming up. We're 2 weeks away. In fact, a little bit less than 2 weeks. It'll start on a Monday. So it's a Monday, Tuesday, Wednesday class is June 14th through 16th. And oh my gosh, I'm so excited about the lineup we've got here with Clint Coons, Mike Koval, Scott Estel, Stacy Acevedo, Kwame Granderson. We've got Bill Danko, the co-author of The Millionaire Next Door. It's an amazing lineup of speakers. So if you have not booked your time for this, if you haven't signed up for this June event, again, it's a Monday, Tuesday, Wednesday class. It'll go from about 9 to 4 Mountain Time. But we're serious asset protection geeks. The agenda is available on our website, protectwealth.com. And Kendall, I think that the new one has been posted. If not, it'll be posted and emailed to everyone who's currently registered. So tomorrow. Yep. So go there tomorrow and you'll get a copy of the agenda that we've got. Open Q&A every Thursday at 11:30 Mountain Time. And then lastly, before we get started here, everything that we do on all of our webinars, there's always a disclaimer. We're talking tax and legal, so you just expect it. We cannot give specific legal or tax advice on this, on a general session. When we have 100, 200 people on a call, we can give general information. We will be very, very accurate in what we say, but not everything that we apply will apply to you. And that's why we're going to give you an opportunity at the end to sit down with professionals and talk about your situation. So we encourage you to take advantage of that. And then again, we'll have a lot of Q&A at the end of this. So with that, let's go back to Steve and Eric. I'm glad to have both of you on. This is kind of an exciting thing. I don't know anyone that understands cost seg better than you guys do. For those of you that aren't familiar with cost segregation, you're going to get really excited if you have investment real estate. We can talk about the cash flow advantages of investment real estate all day long, but the tax advantages, oh my gosh. This is how President Trump used to claim that he didn't owe taxes, is because of all the real estate losses and carried forward. And there's so many tax advantages right now with the current tax laws of owning real estate. But it's only if you're taking advantage of the laws that exist. So with that, Steve, I'm going to turn the time over to you. Maybe you guys could give a little of your background to get started with, and then we're excited to hear what you have to say.
Great. We're going to share our screen here.
Great.
And Eric and I have been doing cost segregation studies for a long time. So I've actually been in the business since 2005. I've done over 10,000 studies all over the country for every type of property, everything from a residential rental to gigantic office buildings and even fun stuff like ski resorts. So this is such a powerful tool that we're so excited to talk about tonight, especially where with the uncertainty right now with what could happen in the tax laws with things changing. This is something that provides a huge benefit for people that own real estate, because it seems as many of the proposals currently from the administration and are harmful to people that own real estate. So this is one of the benefits that we can do, that we can share with you tonight. So we'll kind of go through some of the slides here and just tell you a little bit about how this is really less understood by many CPAs, but it's a powerful tool. Just as Don was saying, people wondered how President Trump had a $900 million tax loss. And I wanted to scream and raise my hand and go, I can tell you exactly how he did it. And it's really simple. And so what we love to do is we love to bring this down to a level that even somebody that has one residential rental can use the power of cost segregation. So we want to talk a little bit about that. We can talk a little bit how we have the TCJA and the CARES Act. These are just acronyms for Tax Cut Jobs Act, which was the President Trump 2017. And then the CARES Act, which is the coronavirus one that was in 2020, the first one. And we'll just talk about what some of these laws mean. So we have a little pyramid here that shows cost segregation with the Tax Cut Jobs Act, bonus depreciation, the CARES Act. These things basically build on each other and make it even better and better for people that own real estate. So we're going to start with the base here. So typically people understand that we have, if you own a property, it's depreciated over 39 years or 27 and a half years. So I own a residential rental. I bought it for $100,000. I can depreciate that $100,000, or I can take a tax deduction of 127.5 every year for 27 and a half years. Well, the idea behind cost segregation is to use this tool that allows us to reclassify some of those 39 or 27 and a half year assets into shorter lives, some of which are 5, some of which are 7, some of which are 15. And then what happens with these is we can actually take bigger deductions faster. There's also some interesting laws that we're going to talk about in the Tax Cut Job Act that made bonus depreciation, where we can take everything in the 5, 7, and 15 year property immediately. as 100% bonus. So let's say you buy a property here in 2020, we reallocate 30% of it. That means you could take 30% of your property as a deduction in the current year. So it's a very powerful tool. So there's a section in the code, it's section 38. And in this section, it's been in there for a long time. And there's parts of it that basically say, if you can remove your property without damage to the building, then it's personal property. So you can see some of our examples here of carpet, countertops, window coverings. There's also things that fit into this category that you may not think that fit into this category. And we'll give some examples of that here in a minute. The next argument in section 38 is the relationship between the asset and the equipment that they would be retired together. So for example, in a home, let's say you have a dishwasher. Well, the dishwasher also has plumbing running to it. It has electrical running to it. Those items, even though that they may be structural components of the home or of a building, you can take those as a short life asset under this section 38. And then the last argument, number 3, is the relationship between the asset and the nature of the business are unique. So something like gas station canopies, ski resort guns, clean rooms, there's a number of things. So this section in the code is what allows us to break these buildings down using these 3 arguments. And here in a minute, you're going to see some of the power that these numbers, what this can actually provide for you if you own real estate or invest in real estate. So here's to give you an idea. So real property, these are the things that should be depreciated over 27 and a half or 39 years. You can see there on the left, steel structures, roof, walls, windows, basically your building structure. Then you can see that I have in the 5 and 7 year category and the 15-year category, and there's a little note under there that Eric and I have that says bonus eligible. And basically, these kind of things are parking lots, curbs and gutters, storm drains, irrigation, bushes, trees, shrubs. People don't think about that, but hey, they're deductible. So when we go do a study, we're out there counting the trees and people are like, what are you doing? And we're like, hey, these are tax deductions. We got to pick these things up. And then in the personal property, there's some of the 5, 7, 15-year items. So any comments on this?
No,
Eric?
I think that the main thing here is that I know when I'm talking to people about cost segregation, I don't think people realize when they buy a residential rental, let's say for $250,000, you don't necessarily put 2 and 2 together that not only are you buying the land and the walls, but you also just bought a bunch of carpet. You bought some countertops, you bought cabinetry, you bought a asphalt, you bought a parking lot or a driveway. But I think that's important that those are the things that we will segregate out. So when you've got that $250,000 purchase price, your standard CPA is not going to know what the value of the carpet is when you bought that asset. And so really going back to the previous slide, that's where we come in and we'll identify those different components and put values to those using the engineering-based studies that we put together. So that's really all I have to add there, Steve.
Okay, great. So the Tax Cut and Job Act had all kinds of different things in it, but the one we want to really focus on is this bonus depreciation. And what it did is it basically said that anything under a 20-year life would qualify for 100% bonus. So bonus depreciation has been around since 2001, basically since 9/11, and it's been in a different form. But one of the things that I think is important is you can see this is an old law that showed different things. Well, when they did the Tax Cut Job Act, they got rid of this. They made this what we're calling super bonus depreciation. So if you've bought a property after 9/27/17, currently through the end of 2022, now this is one of the things that they're talking about getting rid of. And so this is an important item that if you're going to buy a property this year or possibly next year, that you would have this 100% bonus. Now, what it means is you see on the requirements there are a recovery period of 20 years or less. So if you go back to our slide 2 slides ago here, remember that would be anything 15-year or 7 and 5. These things would then become 100% bonus eligible. So, and it begins with whenever you buy it as a taxpayer. So it doesn't have to be brand new. So if I buy a home or an office building or anything, even if it was built in the 1800s, it is new to me and thus qualifies for 100% bonus the minute I buy it. So that's anytime, again, after 9/27 of 17, any of these 5, 7, and 15-year assets that Eric was talking about that you forget about when you buy a property become 100% bonus eligible. And so the numbers become ridiculously huge on this. And we can show that here in an example.
Steve, I just want to go back. I just want to interject here. I think one of the important things too is I think when they decided to put this law into place, typically, like Steve mentioned earlier, real estate is depreciated over 27 and a half or 39 years. And so neither of those have a recovery period less than 20 years. But if you do a cost segregation study, now we've separated that property out. Now you do have 5-year property, 7-year property, and 15-year property, which all falls under this 20-year period or less, which is now 100% bonus eligible. So cost segregation, I think, is more important now than ever, because in order to take advantage of what we call super bonus, and don't Google that, I think that's an internal term that we came up with, but to take advantage of super bonus, you do have to have a cost segregation study done. Otherwise, you don't know what your 5-year assets are worth. You don't know what your 7-year assets are worth, and you don't know what your 15-year assets are worth. So you can't take 100% bonus if you don't have values to those assets, and your CPA is not going to be able to come up with those values. And so that's why I think, again, cost segregation is more important now than ever because of this super bonus and being able to take advantage of it.
Again, this is one of the things that they're talking about getting rid of. So it's a chance to use it now before it's gone. So let's kind of look at the power of this. So this is a residential assisted living home bought for $1.2 million in 2020. The current tax year is 2020. And so let's kind of look at what happens here. So some of the items that got moved to the 5-year assets: cabinetry, appliances, counters, carpets, blinds, ceiling fans, portions of the plumbing specifically related to the dishwasher, the washer and dryers, portions of the electrical specifically related to the washer and dryer, the dryers, the appliances, also to telephone data. There's a whole bunch of things that went to that classification. Things that go to the 15-year that often people forget are retaining walls, grass, sprinkling systems, irrigation, swimming pools, outdoor lighting. So as you start to think about your property, think about how much dollar value this could really provide. And it becomes very significant very quickly in some of these numbers. So in this, remember, we had a $1.2 million purchase. And if you look here at year one increased depreciation of $318,000, we're going to take a $318,000 tax deduction. So what that means is you're being able to offset $300,000 worth of income in the first year that you bought this thing. And what's interesting is you probably financed it. And so you've put down less money than the tax savings that you're going to get, which is a crazy idea, right? To go, holy smoke, I'm taking the money that I was going to have to pay the government, and now I can buy a property, pay off debt, do all kinds of different things because I'm taking this $300,000 deduction, all using this bonus depreciation that's super important right now.
And I think too, just on this slide, over on the left-hand side, you'll see what your deduction would have been had you not done cost segregation. So if you don't do cost segregation, your deduction is going to be basically $43,000, $43,636 every year for the next 27 and a half years. And what we're saying is, instead of taking $43,000 every year, what if we can give you $339,000 in the first year, which is an increase again of $318,000. That's $111,000 in tax savings. And you'll see what we've done is we've got about $216,000 worth of 5-year assets, $12,000 worth of 7-year assets, Sorry, those are horrible circles. $96,000 of 15-year assets. And then again, like I said, $216,000 of 5-year assets. With the bonus depreciation, these $216,000 worth of 5-year assets, they used to have to be depreciated over 5 years. So you would see this number divided up over 5 years. Your 7-year assets would be divided up over 7 years. And then your 15-year assets would be divided up over 15 years. But now with the bonus, you get to take all these deductions in year one, which is crazy. Like I said, you know, Trump was a real estate investor, and this is part of the law for that reason. But that's a huge difference. You're talking at $339,000 of deduction in the first year versus $21,000.
What else is really interesting is, let's say you bought this thing on December 31st of 2020 and owned it one day, you would still take 339,000. So, and if you didn't, that number would be a lot less than 21,000. It may be like 1,000. And so the number of this is just get crazy of how big it gets.
Let me
Gotta
get rid of
erase
my,
our,
let me see if I can erase my pen here. Clear all drawings. There we go.
okay. So different type of buildings have different type of percentages that are segregated. This just gives you an idea of that. Let's see. Sorry,
Oops,
I'm gonna move on to the next slide. That's what we get for doing our fancy circles.
I know, I should have never pulled out the red pen. It screws me up every time. There we go.
So, okay, now this is another very interesting benefit. We'll answer some questions here after we talk about this one. So one of the things that's really interesting is, let's say you bought a property 5, 7, 10 years ago, and you go, oh man, I didn't do cost segregation. I guess I've missed out. Well, the answer is no, you haven't missed out, because there's something called a catch-up that uses a tax form. It's called a Form 3115. It's automatically accepted tax form. Basically, what we can do is anything you should have taken over those 5, 7, or 15 years, you can take in the current year under the tax law that existed when you bought the property, which is also interesting, because it means if you bought a property after 9/27/17, we could still do the 100% bonus, and we could do it on this year's tax return, which is amazing. So we have this catch-up number. So this example is, let's go back to our $1.2 million assisted living. We're saying, okay, you bought it in 2015. Here it is, 2020 tax year. So all of a sudden we can take everything that we should have taken from 2015 to the 2020 tax year, all in the current year. So in this example, we catch up 5 years, take an increase of 203,000, all in the current year. So we don't have to amend any tax returns. We can take it all in the current year. And that's that's another unbelievable benefit of cost segregation, is to go, it allows you to pick and choose what years you put your deduction is. Here it is, June 1st. Even if you filed your 2020 return or haven't filed your 2020 return, if you owned properties, we can go back and do this and pick it up on your 2020 tax return, even until then. So, Kendall, should we stop for a second and answer some of these questions?
Please. I think there's a lot of great questions. Come on. Can you guys see the questions, or you want me to jump on them?
We can see them.
Okay, go ahead.
So let's see, is there a way we can understand what cost seg does before acquiring a property? Absolutely. So one of the things that we do on our side is we do a free benefit analysis for anybody before they ever hire us. So for example, if you called up and said, hey, I have XYZ property, I bought it in this year, or I'm thinking about buying this property, here's the address, here's what it is, we can run a benefit analysis that would look very similar to the calculations that we've just shown you, that would show you what your benefit may be if you did a cost seg. And And that way, you know, one person's asking, hey, my income's over 150,000. I'm not a real estate professional. Can any of this help? And the answer is yes, it can help. It can offset your other passive income, but we'll look at all of that before you ever pay us anything to make sure that a cost seg is going to make sense or what the numbers do. And we'll also get on the phone with your CPA and look at it and go, look, based on X person's properties, here's what we think a cost seg would do. How does it work into the other strategy? And we can answer these questions that the CPA may have because they, again, don't understand this, or if they don't understand it, we can help them. If they do understand it, we can say, here's what the numbers look like. Here's how this could help. Somebody asked, can you do a 1031 and do cost seg together and have the property qualify for bonus depreciation? And the answer to that is yes. You definitely can do that. 1031s, if you're familiar with the 1031 exchange, do work hand in hand with cost seg. So there's a lot of powerful things that this cost seg can do, and it's really flexible. That's one of the best things about it is we can kind of pick and choose where we put our deductions. We can use it with a 1031. We can go, okay, I don't want to do a 1031. I'm just going to pull it out. And people are asking, you know, what kind of properties does this work for? Does it work for condos? The answer is yes. Does it work for Airbnbs? The answer is yes. It basically works for any type of property that you are depreciating for tax purposes, which can be basically anything but your personal residence. However, if your personal residence is an Airbnb, then you may be able to do this. So there's a lot of different things that this does work for. Somebody asked the cost of cost segs, and it's all over the board depending on how big your property is. You know, these studies can be anywhere from $1,000 to 50,000 or 100,000, depending on how many properties, the size of your properties. In our case, we want the benefit to be at least 10 times the fee. Sometimes it's way more than that. But that's just a couple of questions that have been asked.
I see one here. Looks like Paul asked, this was a great question. When you say bonus depreciation, is that in addition to normal depreciation? So Paul, the answer to that, it's not in addition to, it's basically you're at the end of the day, you're still going to depreciate in that example, 1.2 million. It's just that instead of taking 1/27th of that every year for 27 and a half years, you're taking roughly a 30% bump in the first year. So that's where the bonus comes in. You get 100% of your 5-year assets in year one, 100% of your 7-year assets in year one. So we're not creating any additional deductions. We're just accelerating the deductions that are already there. And with this bonus depreciation, like Steve mentioned, it's kind of put cost segregation on steroids and made the numbers really big. But hopefully that answers your question.
And obviously the government gets this. That's why they make you depreciate your property over 27 or 39 years. They don't want you to get this deduction now,
right?
Which is why we're going, hey, yeah, let's figure out a way to get this deduction. So somebody asked a question, hey, I bought this in 2012. Does this not work for me? And as I've explained with the catch-up, it definitely does work for that. So let's continue on, and then we'll ask a few more here in a minute. So let's do just another example. Maybe that'll help answer a few more of these questions. So this is a smaller property, residential rental, bought for $285,000, in 2015, current tax year is 2020. So again, we segregate the parking lot, not the parking lot, the driveway, the retaining walls, some of the things on the inside, the appliances. We have a catch-up number of 48,390 is our increase for that. Catch-up of 46,000, create a tax savings of $20,000 on a $285,000 residential rental. So again, the numbers on this get big fast. You know, sometimes you're at the end of the year and your CPA is telling you, hey, go buy a car or go do this or that, you know, and it's great. It creates good deductions, but nothing compared to what we have here with these real estate deductions that we can create with these properties. So,
And I'll just add there, Steve, somebody asked, if I'm taking all these deductions up front, what does it do to my future deductions? And you've got big numbers here in this red circle here. But in future years, you're still getting $8,912 of deduction versus $10,364. So you're only losing, 1,100, well, it's right there. 1452 over here in parentheses, but you're getting a big bump in year one. So again, there's a number of reasons why you would front load your depreciation. Time value of money, $1 today is worth more than $1 down the road. But that would, hopefully that answers, I know a couple of people asked that question, what happens to deductions in future years if I take all my deductions up front? And again, you'll take slightly less, but I may not even own the property in 2036. So give me my deductions today versus making me wait for a future year.
So we get asked a lot is, well, when do I do this? When do I do a study? And obviously, if you currently own a property, no matter when you bought it, it's worth looking at this. If you buy a new one, if you do renovations, leasehold improvements, before you sell it, if you have a property with a 754 step up or a other step up, this is actually a home run scenario. If you, let's say I own a property, I die, it goes into my estate. Under the current tax law, they get a step up in basis to fair market value. And you do two cost segs, one for the estate and one for the inheritance. And it makes for an amazing thing. That also happens in partnership buyouts and some other things. So basically, in the life of a property, you should do a cost segregation study at some point, or you've left money on the table. Now, if you could tell me what your tax rates are, what the tax rates are going to be, then I could tell you how long you were going to own it. Then I could tell you the perfect time to do the study. But typically we don't know all those things. So we just go with the best information. And usually it's, hey, let's do it now, or let's do it next year, depending on what your income may be in those. We have a slide here on partial dispositions, and this is another tool of the cost segregation study. So let's say I buy a property, I've owned it for 5 years, and then I do a remodel. Well, what happens is typically, if that happens, the things that you remodel just are still stuck in the building, and you're depreciating them for the rest of the time you own the property. Well, with a cost seg, all of a sudden we put a cost to those items that you are disposing of or that you're demolishing, and then you can take a deduction on those immediately without having to just continue to carry that along. So it creates another large deduction that can be used. So let's say you replace the roof. We put a cost to the old roof, you deduct it as a partial asset disposition. The new roof goes on, you depreciate it under the new life, and it creates an immediate tax deduction for assets that you're disposing of. So it's, again, an added benefit to cost seg. Anything on that, Eric?
No, I can just say, we see a lot of depreciation schedules, and I can't tell you how many times I see 2 roofs being depreciated at the same time, which unfortunately creates an inflated recapture when you sell. And we won't go down that road too far, but if you're not disposing of your original roof, you're basically saying that you've got 2 roofs in service at the same time. And you really can't dispose of the original roof unless you have a cost to it. And that's what Steve was getting at, is in a cost seg study, we put a value to your roof. So we put a value to that roof, and when you dispose of it and put a new roof on your depreciation schedule, now you're only depreciating the one roof. And so I see that quite often on depreciation schedules where it's incorrectly being double depreciated. And again, it just causes more tax upon sale.
Okay, so here in the CARES Act, which is the coronavirus package, they did some interesting things. One was the qualified improvement, one was the 5-year carryback, and then there's the 45L tax credit. We're just going to hit these really quickly just because they work hand in hand with the cost seg. So qualified improvement property is basically if you've made an interior improvement to any type of a building other than a residential rental, so it's a non-residential, anything in that can be depreciated at a 15-year life. So if you go back to remember our 15-year life, what does that mean? 100% bonus. So let's say I own an office building, I remodeled the interior, it would be qualified improvement property. Everything on that would be 100% bonus eligible, including things like doors, drywall, all kinds of different items would qualify for that 100% bonus. So again, this is something we'll look at in a cost segregation study to see if you've done anything that would qualify as this qualified improvement property and gets 100% bonus, which is, again, something that was fixed in the coronavirus package. Okay, this is the other thing I think that was in the CARES Act that very few people know about. They made a 5-year carryback provision for NOLs, which means if you have a net operating loss, you can carry it back for 5 years and get refunds on taxes that you've paid. So in a cost seg setting, let's say you own 5 properties. Well, we do a cost seg study on those 5, create a gigantic NOL. Well, if we do it for the 2020 tax year, you could carry it back, clear back to 2015 and get refunds on any taxes you've paid. So the idea behind this was, hey, people, are going to lose money because of the government shutdowns and all of these different things. And so we're going to let them take these NOLs and carry them back 5 years, which typically isn't the case. So this is cost seg's a way to create additional NOLs if that's in a setting that you may be in. One of the other interesting things is if there's a consideration that we have here at the bottom that the corporate tax rate was 35% compared to the 21%. So for some people, we create this deduction, they go back and pick up 35% tax that would only be a 21 and create a permanent tax savings. So again, a lot of interesting, neat tools that can be done. This is an example that just shows, hey, we do a client has 100K of income 2020, completes a cost segregation study, generates a $525,000 deduction. You can see here how it carries back the provision and they get a refund of $115,000 of taxes that were paid currently. Any comments on that, Eric?
No, I was just going to add, typically those losses before this provision, you would have to carry them forward and you wouldn't be able to get those refunds until next year or the following year. But like Steve mentioned, the IRS said, hey, people are going to be strapped for cash. Let's put cash back in their pocket now, and let's use those leftover deductions to apply it to previous income. And it, again, in this example, it's $115,000 tax refund that you would get in the form of a check from the IRS. And they didn't buy any additional properties. All they've done is all they did was do cost segregation work on their properties, create that $525,000 deduction. We wipe out their $100,000 of income, and now they've got $425,000 left over that they get to go apply to income they made back in 2015. So something to be aware of. Like Steve said, a lot of it was kind of tucked away in all the provisions, so not a lot of CPAs are aware that can apply, but something to be aware of.
The other thing that's interesting is this 45L tax credit. This was also part of some of the things that were happening with the coronavirus and some extenders. This is an actual dollar for dollar tax credit. So if you built an apartment or built an assisted living or built houses, you would qualify for this basically by making your property energy efficient. And it's actually a $2,000 per door credit that you can get if you make your property energy efficient. So here's some of the common questions. Can a remodeling project? Yes. Substantial rehabilitation could qualify for the 45L tax credit. Can I apply this for past properties they've built? Yes. Can I be the one to certify? No. Even if you're an authorized ResNet person, you can't certify your own. And is there a maximum credit? And the answer is no, there's not a maximum credit. So Eric, let's take a pause again here and look.
Got quite a few questions.
Quite a few questions that we probably should ask.
I started investing in 2003. Will all my properties be able to take advantage of year one bonus?
So the answer to that is you started investing, said you have 30 properties bought into. The answer is yes, you can take advantage of cost seg. We could look at it and go, okay, here it is 2020 tax year. We could do any any or all of those properties that would allow that to do that.
Another question, can a limited or passive investor utilize cost segregation in the first year? The answer is yes. It can be used to offset any passive income, whether it's through income through rental properties or other types of passive income. You can definitely use the deductions to offset passive income. Let's see, we've got a couple more.
So somebody asked a question here that said they bought it. Go back up a little bit.
Yeah.
That they bought a property that needed a new roof and new appliances and fans, and then new flooring and other things. So the idea, again, what I was talking about partial asset disposition, is to say, yes, let's do the cost seg. Let's also put a cost to those old items that you're demolishing. And so it gives kind of a double benefit. We get the partial asset disposition and we get the new cost seg items that can do that. So that's a really good question that's interesting. So somebody asked a question about where we have recapture. And this is a great question that I really want to hit, because a lot of CPAs say, why would I speed up this depreciation and then sell it just so I have to recapture? And here's the short answer behind that. Why would you ever sell your carpet for more than you paid for it? You never would do that, right? Or nobody would ever pay you more for your used carpet than you would when you bought it. So what happens when actually you sell a property? We don't have recapture on our 5, 7, and 15-year assets, or we have less recapture on our 5, 7, and 15-year assets. So what that means is, again, this is a complex issue. We take a deduction at our highest rate, pick it back up as a capital gain, save the spread somewhere between 5 and 20%. And so again, even if you've sold a property in the two, it still may make sense to do a cost seg on that property that you don't even own, just because you can use this advantage that I was saying, because we have the broken out assets that I can now sell at different prices and thus manage my recapture and create permanent tax savings. So that's a question we get constantly from CPAs is, and they'll tell their client, oh, you're planning to sell this next year, don't do the cost seg. And the answer is absolutely do the cost seg, because you're going to create a permanent tax savings that you wouldn't have without, by using the rate arbitrage between the capital gain and your ordinary tax rate. So again,
Yeah.
a complicated issue, but.
And I think I'll just add to what Steve said. If you think about it, when you buy a property for $500,000, and let's say you don't do cost segregation, and you turn around and sell that property in 5 years for $1 million, you're telling the IRS that everything doubled in value. You're saying my dirty old 5-year-old carpet is now worth double what it was when I bought it. Same with your countertops, your cabinets. And we know that's not the case. The land and the walls might have gone up in value, but certainly my dirty old carpet that I've had for 5 years isn't worth double today versus what I paid for it 5 years ago. And so like Steve mentioned, when you do cost segregation and you've segregated those items, you can manage the allocation of the sales price to the right bucket. So you don't end up paying additional deductions. And to kind of recap, kind of the simple way to say that is, like Steve said, take your deduction at a high rate. You're taking your deduction today at your ordinary income rate, paying it back at a capital gains rate. So if I'm at a 35% tax bracket, I get to take my deduction at 35%. Even if I'm paying 100% of it back, which I'm not, I would pay it back at 20% and save the spread. And so, again, kind of a complicated issue, but if you've got more questions, we'll give you our contact information here at the end, and we're happy to go through it individually, but definitely a question we get quite often.
Somebody asked about what happens if you have an IRS audit, and what's our experience with the IRS. What's great about this is the tax law on this is super solid. There's lots of court cases that go around Section 38, which was the section I talked about in the code. And so we've had excellent success in defending these. Our reports are typically 20 to 40 pages that have all the tax law baked into them on why we took what and why we did what. And most of the time we hand that report to the agent and they go, okay, great. I'm moving on to LIFO, FIFO, or I'm moving on to some Schedule C or something else in the tax return. And so we've had excellent success in talking to the IRS. And again, there's lots of case law that says this is what you do and this is how you do it. And so that's what we do with that.
Someone asked a quick question. Can you depreciate land? No, you always have to take out the land value. So if you buy it for 350 and land is worth 100, then your depreciation, your adjusted basis, you start depreciating at 250. So land is non-depreciable. Someone asked that question. Anything else as a rental property? If a rentals property is purchased using an IRA account money, should we do cost segregation?
The answer is no, unless you want to get it out of the IRA. So basically the IRA obviously isn't currently paying tax, right? So if the property's held in the IRA, it wouldn't qualify. But if you are trying to get the property out of the IRA, that may be a great way to do it, to create deductions to get it out of the IRA and not pay tax. Again, a more complicated issue that we could talk about, individually. So that's that's some of the questions. We'll come back here in a minute to some more of them. But what does all this mean? I mean, that's the important part. It's like, okay, I'm an investor, I'm a CPA, I'm thinking about buying property. What the heck does this all mean to me? And what cost seg means is it is an unbelievably good tax tool for people that own real estate to manage their income. It also is a great way for properties that I've owned for a few years for me to create tax deductions in the current year that I didn't even know that I could get. So again, it's a very powerful tool. The Tax Cut Job Act have really supercharged this strategy. And again, under the current laws, this is a great time to be looking at this because some of this stuff may go away under the new administration. And so it's a tool that we think that you really should be looking at almost on any property that you own. And again, where we'll do a free analysis, it really doesn't hurt anybody to at least check it out and see how's this going to look on my property, or what would it do for me, and we can go through all of that on what that means. So you can fill out the form here on the Protect Wealth. We can look at it. You can also call us, Eric's phone number, emails there. Dawn, are there questions that you think that we should answer that we haven't, or Kendall, while we look through some of these others here?
No, I thought that was fantastic. I think a lot of our students clearly, based on the questions that are coming in, a lot of our students absolutely could benefit from this. And you guys have done an analysis on my property. It was really, I got several different properties we've looked at over the years with clients and me personally with you guys now. I love it. The information is absolutely incredible. And man, you opened up my eyes to a ton of different things too that I didn't know about. So we appreciate it. So, all right. So it looks like you've answered a lot of the questions. Gosh, it looks like you guys did it. So,
hold on, Kendall, there's a couple more here. Go back down.
I see the energy efficiency question. I think you guys covered a lot of that.
A couple of those that I want to hit. And then somebody ask about solar panels. Solar panels are 5-year assets that are 100% bonus eligible. So somebody wanted to ask that. The energy efficient is basically broken down into a couple of parts. So when that 45L deal, the credit is related to, you need to use 50% less energy than a property that was placed in service in 2011. So under many of the current building codes, they're going to force you to do that anyway. So again, it's a $2,000 per door credit, and it's one of the things we can look at with you individually even beforehand, we can pretty much tell whether you're going to qualify or not. If we know what kind of HVAC system you have, what kind of insulation you put in, those are some of the big issues related to that, what kind of SEER unit and how efficient your furnace is. So if you have a 90% of furnace and a 15 SEER, you're going to qualify. So for you HVAC people or anybody that knows anything about that, those are some things that would help you do that.
And I wanted to jump in there and let you know too, I did put the link in the chat screen. So if you guys are wanting, and this is a no cost analysis from Cost Seg Authority, that link is there, protectwealth.com/cost seg. That's cost SEG, cost seg. Click on that. And any more details about what goes into that, guys?
Basically, all we need to know is what you bought your property for, where it's at, just some minor information, and we can start to look at it. We can use Google Earth and some other tools to figure out what we think your property would look like if you actually had a full study done. Also, we can have your contact information and we can talk to you individually and say, okay, here's your situation, here's how it might look, basically, so that we want you to get a benefit for this before we ever, you ever pay us a fee, because it doesn't make sense to us to do a study and you don't get any tax savings. If you didn't qualify, we would say, hey, you don't qualify. And if you do qualify, we'll tell you. And I mean, 99% of people, this is going to help. There's the occasional person that isn't paying tax or has some other really unique issue that we say, okay, hold on, let's keep this in your back pocket. Let's do it next year. Let's do it a different time. So
we just had another question come in that I think is a good question to answer about, can I still take advantage of this on my 2020 taxes? And the answer is yes. If you filed an extension, even if you haven't filed an extension, you can still go back and amend and take advantage of the cost segregation studies on your 2020 taxes. So something to keep in mind. Another quick question was, do the cost seg rules apply in all states? Yes, the cost seg rules do apply in all states. However, bonus, whether or not your state recognizes bonus depreciation is dependent upon the states. I don't remember how many states.
So for your
14? I think there's 14 of them.
For your federal return, 100% of the states obviously have the federal bonus. So this is the question is, this also works for your state taxes.
Right.
So for example, if you were in California, can you do cost seg and would it apply to your California tax? And the answer is yes. Now, would the 100% bonus qualify in California? And the answer is no. So when we do the cost seg studies, we do a federal schedule and we do a state schedule. So you do save taxes on your state taxes for this. Now, if you're in a state that like Nevada or Texas or somebody that doesn't have a state income tax, then you only get the federal benefit, which is usually 35, 37%. So
it's huge.
Yeah.
It really is huge. And the thing is too, I know it sounds cheesy, but you have nothing to lose and all to gain here. I mean, really, if you have any type of rental property or even otherwise, sometimes you really do have nothing to lose and everything to gain here. And we do a lot of things like this, here at Protect Wealth, where you learn a new tax strategy, and upon applying it, is there a cost? Yeah, sometimes. If there is a cost, I know for sure you guys, the benefits far outweigh any cost. And that's always your goal. So really, truly fill out, if you have any question, fill out the form, they'll get back to you. And I know there's only one room for one property on the form. If you have more, I'm sure Eric and Steve can get more detail from you when they contact you.
Yeah, if you guys put your contact information in there, which you will, because I think it asks for that. But before we start running any numbers, we're going to call and just go through the information. So just put one of your properties on there. We'll call and get all the other information we need. But we'll definitely reach out before we run any numbers so that we've got your total portfolio available. So
Steve, go ahead.
One other quick question. Somebody said I filed an extension. Is it worth trying to do the cost seg before filing, or can I wait to file an amendment later? The thing with that form 3115 is it should be timely filed, including your extension time. So there is a chance that you could hurry and do it before. It's always better to do it before you amend. So my suggestion on that would be, hey, let's get it done before, since you have till September or October currently to do that, and that's plenty of time.
And you guys you probably heard this. I don't know if you've heard this, Steve and Eric, but we've heard real estate makes millionaires, but cost segregation is the millionaire maker, right? Because it's true. You have real estate.
That, but that's a good one, Kendall.
It's true. It really is.
Start telling everybody that.
Well, it's a ninja type of, strategy that most people don't know about. Even if they do, the CPA, your brother-in-law has been doing your taxes for 20 years. Well, shoot, he doesn't know about cost seg. I just found somebody who had never heard of 1031 exchange and been doing real estate for decades. It just blows my mind. If you don't know, you're missing out on tens of thousands, if not millions of dollars that you could have invested over the years in real estate. And that literally is true. So I like it. Millionaire maker strategy. I believe it.
Very good. I think that's all we have. If it looks like the questions have slowed down, I think we've answered most of these. We got a couple questions for cost. I know Steve kind of touched on that. It's kind of a wide range. Single family rental homes, anywhere from, $1,500 up to, we do ski resorts for $50,000. So it's a wide range. The big variables there are the size of the property and the type of an asset. A warehouse is a little easier for us to do than a single family rental home, for example, or a retail strip mall that's got 6 tenants and we have to get into each of the spaces to view the property. And then maybe I should touch on that because that we kind of segue into that, but kind of the process is we run the benefit analysis. If it looks like it makes sense, the IRS does require us to do a site visit on each of these properties. So we will do a site visit on your property. And then what we prepare for you guys is it's usually about a 40 to 60 page report that has what your CPA is looking for is basically the new depreciation schedule that will show them what the 5-year assets are valued at, what the 7-year assets, 15-year, et cetera. And then there's a lot of case law and stuff that goes behind that and a lot of backup documentation. But that's kind of what we're providing to you guys is the report. And then your CPA takes those numbers, puts it into their tax software, and then that's where the deductions are created and that's where the tax savings comes from. But I think that's everything, unless you guys have something else, Kendall or
No,
John.
so I guess the only question we get quite a bit is, okay, so I'm doing all these new tax strategies. So does my audit risk go way high by doing this? And people just are afraid to do anything new. Home office deduction, why take that? This is a whole different strategy, but does it increase your audit risk?
So the answer, so you obviously can never say never, but I told you I've worked on 10,000 studies and the number that's been audited is 20 or less.
Wow.
So
Wow.
if you want to say what's your audit risk, personally, I say it's very low. But obviously you can never say never, and we're happy to defend it. If you get audited, we want to defend it because we do it right. We want to follow the law, and we're going to follow the law, and we're going to do it right, and we're going to give the IRS a report that stands up to what they want. And so,
yeah, and it's not like just because you got
no fear.
Yeah, no fear. And that's the thing is too, don't let that fear stop you from doing something, because what's the worst can happen? You get audited and they'll back you up. That's it. I mean, as long as you're not hiding money somewhere, audits are no big deal. They really aren't. It's not a big deal at all.
We got a question about, do we travel nationwide? And the answer is yes, we do. The other thing that's kind of interesting, because of some of the coronavirus stuff, we do some of our site visits virtually. If people are uncomfortable with that, currently. So we do travel and we do virtuals and we make it work. So we've done My favorite place is if you have a property in Hawaii, I would definitely want to visit that. If it's in North Dakota, I don't want to go there in January, but I have been to North Dakota in January. So
Sounds fun. uh, well, you guys are awesome. So it works in all 50 states, and pretty much anybody with any type of real estate, just about, it's worth taking a look at. And I know we've sent several people your way and nothing but good things to say about you guys, your professionalism. And gosh, I mean, it's saving thousands of dollars. It's worth a look. So a lot of you are on your phone here. Again, the website to go and sign up for a free analysis with Cost Seg Authority is protectwealth.com/costseg. Take a look there, and we'll send an email out tomorrow with the recording and the link again. Really appreciate it, you guys. Steve and Eric, we really appreciate it very much. You guys taking the time to be on here. Great information. I even learn more every time. So really appreciate it. Anything else you want to say before we wrap up?
just to say, Todd invited us to lunch in Long Beach. We're in.
We're in.
See, bring it on. We need some from
Somebody
Hawaii
asked
out
about
there.
Mobile home parks, and that's a big. They are unbelievable.
Yeah, they could be a home run. So they
So.
are one of the highest segregated asset classes. So definitely reach out, Stephen, because those could be a home run. So I think that's it. Well, thank you guys again for your time. Thank you everyone who joined. Thanks, Don. Thanks, Kendall. Again, my number's there. If you've got any questions, feel free to reach out. That's my cell phone number. I try to answer it anytime I'm available. So definitely reach out. We want to be a resource for you guys. Trying to think, the weirdest depreciation question I think we've been asked is how to depreciate what was it? The deer in Wisconsin.
Deer breeding facility.
Deer breeding facility. How are mule deers treated? So I had to go to Steve for that one, but we want to be a resource for you guys. If you have any depreciation questions, feel free to give me a call. If I can't get the answer, we've got plenty of resources here in the office that can get you the answer. So please feel free. Don't hesitate to reach out. And I think that's everything.
Yeah, and Elisa, I see you're asking questions. Give us a call here. Give Steve, Cost Seg Authority, Eric a call there. They can help you out. We try to get all the questions we can, but can't always answer them all. So appreciate it, guys. And it looks like there's a few questions on properties sold. That's probably more individual with you guys. If there are questions on properties that have been sold for a while, probably fill out the form. That's the best way to get individual answers.
Yeah.
Alyssa will get to you. Yours are harder questions to answer. So we do want to talk to you.
Yeah. Fill out the form, Alyssa. We'll get your contact information and we can discuss that. But yes, it may work on a sold property. So we'll run the numbers and take a look.
Great. Well, guys, again, thank you so much. It's good to see you. We really appreciate your time. Good information. Everybody else on the call, thank you so much for your time as well. If you have any questions, please reach out. We're always happy to help you. We'll look forward to seeing you guys all again another week. Have a great night.
Sounds good, guys. Take care.
Thanks, guys. Take care.
Bye-bye.